$13 trillion moved last year through a platform Ripple now owns, and not $1 of it touched a crypto rail. If you think that's a problem, you're looking at this completely backwards. What you're about to hear is going to reframe everything you thought you knew about where XRP fits in the global financial system. Here's what this video is actually about. Ripple is sitting on top of the largest documented gap between traditional payment infrastructure and blockchain settlement rails that has ever been publicly quantified by a major crypto CEO. Most people hear that and think Ripple is behind. The conventional wisdom says if your own platform is processing $13 trillion with zero crypto usage, your blockchain product is irrelevant. That take is wrong and dangerously incomplete. We're going to break down the DTCC connection first, then the $13 trillion opportunity, then the institutional derivatives signal at CME, and finally how the macro backdrop ties it all together. This analysis is built entirely on publicly reported data, executive statements, and verifiable market infrastructure. No price predictions, no speculation, just the dots and how they connect. Here's the signal most people completely missed. Ripple Treasury and Ripple Prime have developed a netting solution that is now listed under the DTCC, the Depository Trust and Clearing Corporation. Let that land for a second. The DTCC is not a startup. It is not a crypto-friendly PR vehicle. It is the central nervous system of United States financial market infrastructure, clearing trillions in securities transactions every single day. Getting a product listed there is not a marketing move. It is a compliance event. It means institutional due diligence has been completed at a level that most crypto companies will never reach. The reported figure attached to this solution is a 60% reduction in FX fees and cross-border payment costs. Treasury departments at major institutions do not need to believe in the crypto ideology to run a pilot on that math. They just need the numbers to hold up. And when the most credible financial clearinghouse in America puts its name next to your product, the numbers at least get a serious look. This is how institutional adoption actually begins. Not with a tweet, not with a price pump, but with a listing in a system that pension funds and compliance officers already trust. But here's where the story gets structural in a way that changes everything. Brad Garlinghouse said it directly in a televised interview. Last year, the company now called Ripple Treasury orchestrated $13 trillion in payments. 0% of those were through a stablecoin or crypto. He was not embarrassed by that number. He called it the opportunity. Think about what a CEO is doing when he voluntarily quantifies the gap between where his infrastructure currently operates and where it could go. He is not hiding a weakness. He is mapping a runway. Fortune 500 companies, large enterprises, institutional treasury operations, all of them are already plugged into Ripple's dashboard. The switching cost to introduce a crypto or stablecoin settlement option on a platform they already use is dramatically lower than onboarding them from scratch. Garlinghouse described it precisely. You're making a payment to the Philippine peso. You can send it the traditional rail and wait 3 to 5 days at a known cost, or you can settle it in under a minute at a fraction of that cost. The infrastructure already exists. The relationships already exist. The pitch at that point is just math. And when Ripple introduces RLUSD as the first layer, stable, dollar-pegged, zero volatility risk, and then shows those same treasury operators that XRP can clear the same transaction in 2 to 3 seconds without requiring dormant capital parked in foreign currency accounts, that is a product sequence. That is a sales motion. That is not speculation. That is the playbook being run in real time on $13 trillion worth of existing relationships. That works on the infrastructure side. But if institutions were not treating XRP as a serious asset class in derivatives markets, the whole thesis could still be written off as enterprise vapor. It cannot be written off. The CME Group just released its Q1 2026 crypto derivatives snapshot, and it reported record activity in its XRP options suite. Record. Not growth, not strong. Record. The CME is where institutional hedgers operate. These are firms with compliance departments, risk managers, and fiduciary obligations. They do not take derivatives positions in assets they do not intend to hold or actively manage. Options volume at that scale reflects directional conviction and risk management behavior, not retail momentum. Separately, XRP ETF exposure has grown to approximately $1.43 billion in net assets held through regulated vehicles. with consistent inflows over recent months. Institutional allocators now have a familiar, regulated wrapper to access XRP without touching a crypto exchange. The derivatives data and the ETF flow data are telling the same story from two different directions. Institutions are building positions, managing exposure, and hedging risk in XRP at a scale and through a mechanism that simply did not exist 2 years ago. The macro context adds one more layer worth watching. Reports emerged this week that the probe into Federal Reserve Chair Jerome Powell has been dropped, which analysts are interpreting as clearing a path for a potential Fed leadership transition under the current administration. A Fed chair change carries its own uncertainty premium, and no one should tell you with confidence what it means for any asset price. And if they do, they are lying to you. What it does mean is that one category of macro uncertainty may be narrowing, and institutional asset allocation decisions are always made relative to the broader monetary policy environment. A clearer picture of Fed direction, whatever that direction turns out to be, reduces noise for the firms already building XRP exposure. That is worth monitoring without overstating it. Here is where all of it lands. Ripple owns the platform. Ripple owns the rails. Ripple has a DTCC-listed netting solution. Ripple has $13 trillion in existing enterprise relationships where 0% have migrated to crypto yet. The CME is printing record XRP derivatives volume. ETF inflows are consistent. The stablecoin market processed $33 trillion in 2025, spread across multiple assets, which means the winner-take-all narrative is dead, and the interoperability play that Ripple has always been building toward is now the actual market structure reality. This is not a story about price. This is a story about infrastructure reaching the point where the migration Garlinghouse is describing becomes mechanically possible for the first time. The gap between 13 trillion on traditional rails and zero on crypto rails is not a failure. It is the largest documented on-ramp opportunity in the history of this asset class. That story is still being written. But the foundation being laid right now is real. It is verifiable, and it is unlike anything that existed even 12 months ago. As always, nothing here is financial advice. This is analysis based on publicly available data and reported executive statements. Do your own research. Your financial situation is your own. But if this breakdown added clarity to how you see the bigger picture, make sure you are subscribed so you catch the next one.